7 more minutes. like most of you are pretty well done. You're kind of checking things. Okay, so here's how this is going to work. All right, that is the first quiz. Hold on to everything for the moment. So the second quiz, the thing that I did not tell you, is the second quiz is much easier than the first quiz. And the second quiz won't take as long. So, and actually the material, we've covered a lot of the material already for the second quiz by virtue of what we talked about tonight as it related to the cash flows. So what we're going to be able to do, we will get through the material for the second quiz here probably within 15 to 20 or so minutes, and then you will have the remaining time to work on both the second quiz as well as finish up your answers on the first quiz. Does that make sense? I know it's very nice. Okay, so let's talk about the few little remaining bits, if you will, for the second quiz. So the second quiz, the second material, if you looked at the handouts, the second one was based strictly on sort of cash flow, dealing with looking at the income and looking at specifically potential rental income, subtracting out vacancy and collection losses, effective rental income, operating expenses, operating income, so forth, so on. If you looked at it. If you didn't look at it, we already did it in class, all right? So that piece of it, you should have under control, okay, from the first part of tonight, if you took good notes. But it's also embedded within the actual handout that I gave. Now, the part that we have not covered, that is on the second quiz, one of the metrics used to evaluate the viability of a commercial property is what is referred to as a gross rent multiplier. You may have heard of it before. Very simply put, it is taking the purchase price or the listed price of a property, dividing by the potential gross income or potential rental income, and that gives you a gross rent multiplier. So, as an example, if we had a purchase price of $1 million and our potential gross income from the property were $100,000, our gross rent multiplier would simply be 10. So all you're really saying is the income, the maximum income that this property generates over the course of a year, you would simply take and multiply that by a factor of 10 to give you the value. Now, super simple metric. It's really just the inverse, to a certain extent, of the cap rate, except that here you're using the potential rental income, not the net operating income. So this is a metric that you're just simply looking at it's kind of like an income multiplier. For those of you with any sort of a finance background, you may have have heard of income multipliers. That's all you're really talking about here. Is you're just simply saying for this particular property, its value is 10 times greater than its annual income. Does that make sense? So it's just a multiple. Okay, any questions on that? Now, how would you use this? Well, potentially to compare one property up against another. So if you had another property that, let's say, was also valued at $1 million, but had $200,000 of potential rental income, what's our gross rent multiplier going to be? $1 million divided by 200,000, is that not 5? Yes? Okay. So in this case, what we're saying is that the value is 5 times greater than the income. Now, which of these two properties would we prefer? The second one. Even though it has a lower gross rent multiplier, the reality of it is this is the better property because it's generating more income relative to the overall value of the property, okay? So in comparing one to another, what you're sort of looking for is ideally you're looking for a lower value there. Okay, moving forward, sort of counterintuitive. All right, acquisition cost. Whenever you're looking to determine or calculate a cap rate, one of the additional pieces of information that you may be provided with are acquisition costs, which are going to be on top of whatever the purchase price is. So you may have a situation of where you have a property that has a $1 million purchase price, but also has, let's say, $150,000 of acquisition cost. Now, acquisition costs are going to be things like appraisals, things like brokerage fees, things like closing costs, you know, all of that sort of stuff. But that is something going to be added to your purchase price to have your total acquisition price, in this case, $1,150,000. So total acquisition price. Now, when calculating like the cap rate, as an example, if you had this property and it had $200,000 of net operating income, in order to get the cap rate, you're going to take the $200,000 divided by the total investment price or total acquisition price. And that would be a cap rate of 17.4%. Okay? Obviously a very high cap rate, but you understand what you're being given. Okay? Fairly simple. So all I'm saying here is don't leave out the acquisition cost. Okay? Hint, hint. Okay. All right. Moving forward. Okay. Another thing that you need to be able to do is potentially whenever you are given a potential gross income or potential rental income or total operating expenses, in many instances you're going to be given a growth rate that you're going to have to apply to that in order to see what the future years of income or expenses may be. So as an example, you could have a situation of where the PGI is going to grow at 2% a year, and you want to, figure out what, if for example, you've got vacancy and collection losses that stay constant, at 10% of potential gross income, you want to find out what the effective gross income is in a particular year. So, as an example, what we would potentially have is your PGI, let's say, at $10,000 in year one. In year two, to get year two, you're simply going to take that 10,000, multiply it by 1.02%, or 1.02, and that's going to give you the second year of 10,200. To get the third year, multiply it again times 1.02. 10,404, and so forth, so on. Does that make sense? Okay, go from one year to the next, 2% growth rate. You're basically multiplying basically 1 plus the growth rate. All right. Now, in terms of the vacancy and collection losses, saying they stay constant at 10% of PGI. Well, 10% here is going to be $1,000. 10% here is going to be 1,020. 10% here is going to be basically 1040. Okay, does that make sense? So that means your effective gross income would be 9,000. $9,180. And $93.64. Okay, so if I were to ask you, assume that you have a 2% PGI growth, and your vacancy inflation losses stay constant at 10% of PGI, what would be your EGI in year 3? 93.64. Make sense? Okay, and be able to do basically the same sort of thing for total operating expenses, same process. Okay, all right. Next little thing is the reversion value cap rate. If you remember, one of the things that we talked about was that at some point you're probably going to sell the property. Where do you come up with the reversion value if you're using a cap rate? Okay, typically what you're going to do is you're going to look to the subsequent year's projected NOI and then apply the cap rate to that to come up with the reversion value. So, if you have a property that has a 5-year hold, okay, that means in terms of your NOI, you're going to have NOI for year 1, year 2, 3, 4, 5, and you're going to go ahead and project what the NOI for year 6 would be. Okay, I mean, all of these projections, but you're going to go ahead and project out to year 6 and get whatever the NOI is for that year. So assuming the NOI is $10,000 for year 6, you would simply apply whatever the cap rate is. So in this case, if the cap rate were 10%, then that means the property would have a value of $100,000. Now, why do you use year 6 to apply the cap rate to come up with a reversion price? Well, because the reversion is going to be added to whatever the net operating income or the before tax cash flow is for year 5, okay? And so in order to find what the value is at year 5, you're basing it off of the future income for year 6. Okay, that is the standard practice when determining the reversion value, is to always look forward to the following year. So in other words, if you're doing a 10-year hold, you're going to look at the 11th year NOI, projected NOI, to determine the reversion price. Okay, because the assumption is that that income is next year's income. So that's what you're going to be concerned with in terms of determining value. You're not concerned with this year's income, you're concerned with, if you're selling it this year, the value is based off of next year's income.
So when we say, oh, you're holding it for 5 years, you wouldn't subtract like your expenses from the 5th year, instead you would go to the 6th year?
You would go to the 6th year. I mean, you're still going to use the income numbers for the 5th year as part of your cash flow, but to come up with the value estimate for the property, you're going to use the 6th year. And the whole reason is simply that that number is incorporating the future value of your income stream, not what it currently is that year.
But on year 6, are you still going to take out the
yeah, you're still going to take out whatever expenses you have for that year, or what they're expected to be. It's just that has been, still is standard practice to use the following year, because mathematically, the whole idea behind it is you're looking at that future income as the basis for the valuation. not past income. Okay?
And just to add something, when real estate properties sell with low assessed value, sometimes they get reassessed, and we often use the higher the future tax value, which sometimes gets increased on a sale, in figuring out like what the NOI will be.
Well, that's another good point to make, is that what Jordan's saying, that, like, for example, if you sell a property for substantially more than what its property tax value is, chances are there's going to be a case that that purchaser is going to end up having to pay more in property taxes because the valuation of the property taxes are going to be increased from 1 year to the next. I mean, for example, I've had properties where the property tax value at the time of sale was, let's say, $200,000, but I actually sold the property maybe for $700,000. So the new owner is going to be assessed property taxes based on the $700,000. Does that make sense? Yep.
What was that 10,000 under 6?
That is the projected NOI for year 6.
And then you just tell them that's by
Divided by 10% cap rate
cap rate.
gives us the value for the property, reversion value.
So that's the cap rate.
Okay?
Reversion.
And the rest of it we've already done in terms of internal rate of return, net present value. Okay, I think you're ready. All right, so basically you've got an hour to finish up part 1 as well as to do quiz 2. Okay, any other final questions? Okay.
Are these the notes you're referring to?
Yep, the ones I sent to you via email. What was that?
Just from the CCIM?
Yep, yep. Once again, now you can work on both parts 1 and 2. And you have until 10:30.
Is it supposed to be effective?
No, potential rental or potential gross, either way you want to call it.
What is it, this vacancy taken out?
No, but read the next question.
Oh, sorry.